My taxes are over $1 million in 2024.
That's too much.
I didn't even make that much money personally. So what I thought I'd do in today's video is I'd talk about how did this happen. I'm also going to talk about how I'm going to handle it, and we're going to talk about what I'm going to do different for 2025. My name's Chris Naugle, and this is What Now? What's next for my taxes? If I'm like any of you, I hate finding out how much I owe in taxes. Taxes! You know, through the year, I kind of have an idea, but then you're waiting for that one moment where your CPA or your tax professional drops that number on you. And when I got my number of well over $1 million, I'm like,
whoa, stop the train, hold on, I gotta get off because I didn't even make that much money. So how do I owe that much in taxes?
And that's exactly what we're gonna look at. But we're gonna not just look at that. Later in this video, so you gotta stick around, I'm gonna go through exactly what I owe, and I'm gonna show you exactly what I'm doing about it. If any of you are following this channel, my guess is you're trying to learn the truth about money, and you're also trying to build wealth. And as you build wealth, guess what? The problems get bigger as your wealth gets bigger. The problems change. At first, it's like, how do I build wealth? Great, I'm building wealth. Then it's like, oh, how do I pay less to the government in taxes legally? And that's exactly what we're going to do. But I think it's important that we just take a moment and go back in time to look at where taxes were compared to where they're at now. And I got some bad news for you. Did you realize we are at the lowest tax brackets pretty much in history? Well, let me show you. Check this article out right here. This is the history of U.S. tax laws. Now, I just want you to focus on a couple of them. 1936. In 1936, the top tax rate was 79%. 79%. Let that sink in. We're complaining about taxes today. Can you imagine being back then, being in the top tier? You gave away almost 80% of your money, your income to taxes? Screw that. Let's fast forward to 1945. Look at this. 80%. The top tax rate was freaking 80%. How many of you would literally work as hard as you do now if you had to give 80% of your money back to the government in taxes? Heck, I bet you most people wouldn't even lift a finger to work if they had to give 80% of it up in taxes. But you see, that's what we're going to go over. I don't care if your tax rate's 79%, 80%, or 1986, the top tax rate was 50%, but there was a big tax reform, very similar to what they're proposing in this administration. But in 1986, that top tax of 50% went down to 28%. Not only that, corporate tax rates went from 50 to 35%. We've seen these kind of tax reforms in our lifetime, and we're going to see more of them probably in the coming years. But the most important thing I want to preface about these tax rates is, do you think the wealthiest people, the highest tax rate folks, do you think they actually gave up 80% of their money in taxes? Or do you think they figured out how to legally navigate the tax code and do things that made it so they, well, didn't pay 79%, or didn't pay 80%, or didn't pay 50%? They didn't do anything illegal. They didn't do something to kind of skirt around it. They learned the tax code, which is what I've been forced, and I mean forced to do, but I haven't just been forced to learn the tax code. I've made so many freaking mistakes, and I've had those mistakes were escalated by bad CPAs, bad tax advice, and I have finally got on the right side of that. And that's what I want to share with you today. I want to hit on one more thing. During the Great Depression, those were hard times, weren't they? Well, look at this. FDR didn't do what you would think during the Great Depression and drop income tax rates to stimulate people to go out there and spend money. What did he do? Jacked income tax rates way up. That makes no sense. So I don't know if we're going to follow that path. I would doubt it. But when we go into a recession, I don't want you to think that all of a sudden your taxes are going to go down. In most cases, taxes go up during those periods of time. But at the end of the day, the U.S. was created to avoid these current situations. It was literally created to not pay taxes. But that all changed in 1913. At the end of the day, if you study history, the United States of America was created to avoid situations like we're in right now. This channel doesn't exist without you, so click the subscribe button. There's a little bell up top. I want you to smash that bell. That little bell will notify you every time I go live so that you can join me and learn all the things that me and Mr. Nelson already know.
Yes.
You see, there's this thing called wisdom, and you only gain wisdom by screwing up, by failing, and you fail forward. And when you gain wisdom, which is something that takes a lot of time to get, the best thing you can do with it is pass it on. Isn't that right, Wilson?
Yes.
Yeah. All right, well, let's move on. And Wilson, come on, you're not in the show anymore. Sometimes he just gets so caught up into the show, he doesn't want to leave, but he's got to go, right? He's got to go. Let's talk about where you live. The state you live in definitely matters. Check this chart out. The top 10 highest income tax rates by state. For all you Californians, California, 13.3% for individuals earning more than $1 million. A 1% surcharge for mental health services. What? Applied to all income tax brackets. Obviously, they got a mental health problem down there in California. Yep. Well, how about Hawaii? Now, you probably don't hear much about Hawaii, but they're dinging 11% for singles earning only over $200,000 and couples earning over $400,000. And then there is my lovely state. Oh, how I love New York. 10.9%. 10.9% applies to individuals earning more than $1,077,550. Who the hell came up with that? And couples earning more than $2,155,350. You'll notice that New York is the only one that comes up with the wacky numbers. The rest were pretty basic. Hey, if you earn more than $1 million, you got to pay this. But nonetheless, those are the three highest. And then from there it goes in order: New Jersey, Oregon, Minnesota, District of Columbia, DC, Vermont, Iowa, and Wisconsin. Yes, those are on top of the federal income taxes. You know, that's why I want to bring up this over $1 million that I will have to technically pay in taxes, or I'm supposed to pay until I decide how much is my fair share, which we're going to talk about that fair share. So out of that, about $280,000+ of that is state income taxes. When I met my new CPA, which he's fantastic, because I came from two CPAs that were awful. So then I was referred into this CPA, and he's a specialist in tax planning and tax strategy, and he's very good, works with lots of high income earners. And you know what he said? I was kind of pissed. The first meeting I had with him, he said, "The best advice I can give you," and I'm like,
Yes! What is it, Mark? What's the best advice?
he told me to move out of New York State with a little chuckle. Yeah, Mark, well, you know, about that. That sounds great. I love that tax advice, but I'm not going to be able to move out of New York State right about now because my mom's here and I'm pretty much all she has. And my daughter, you know, she's in school here. She's got a great school. And my mom loves seeing anyway, nonetheless, I'm not moving out of New York. So, Mark, we got to find a better solution here. We got to find some other things we can do. Well, let's dive into those other things, shall we? Because how about this? If any of you owe a bunch in taxes, you got to make a decision. Do you want to give that money to the IRS? Or would you like to be in control of where that money goes so that it can serve your greater purpose, so that it can serve your charitable needs, and so that it can serve, well, you instead of the IRS? Isn't that what you want? Well, there is a path. It's not just one path, and it's not just one thing. I wish it were that simple, because that's how I got in this mess. I had a really bad CPA who made things seem, oh, it's so simple.
All you got to do is this complex structure, blah, 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 and you don't have to pay much in taxes at all.
Come to find out, when I met with a tax attorney and I had them review my entire complex trust structure, well, they blew it out of the water. And then I was like, all right, you're a tax attorney, but let me go to a CPA. So I hired 2 CPAs to do an audit of this complex trust structure, and they both said, nope, you are definitely not doing this the right way, and there's going to be some problems if you don't fix this problem. So nonetheless, I undid the whole structure, and I found what is the right way. Now, let me be clear. When we go into what I'm going to tell you, I am not giving you tax advice. I'm not giving you professional advice. I'm telling you to go get your own CPA. Get yourself a good CPA that knows the tax law, that knows tax planning. And a good CPA is not a CPA that ends up telling you in the 3rd or 4th quarter of the year that you got a little bit of a tax problem. A good CPA in good tax planning starts January 1st, and you are planning the entire year. Are we clear? Because that's the only way. That is the only way. So let's get into this. So the thing I said earlier is my tax liability is well over $1 million. But remember I mentioned I didn't even make that much. Doesn't that seem strange to some of you? Like, well, how can you owe over $1 million if you didn't even make that much? Well, I personally didn't make that much money. So if I owe over $1 million personally, but I didn't make even enough to pay over $1 million, like where's the disconnect? Well, if you know anything about pass-through entities, you would understand that. I have, I think, and I might have this wrong, 16 or so different companies, all of which are pass-through entities. So what is a pass-through entity? Well, I think the easiest way for me to explain a pass-through is basically just by drawing it. So there's your income, right? Let me just put this, your W-2 income. So we all have W-2 income, or most of us do, but there's your personal income, and that could include 1099 and K-1 income. Now, that is you. But then you've got all your companies, or maybe just one company, and a lot of times people set up LLCs, limited liability corporations. Now, these companies make bunches of money, okay, and then we get a bunch of expenses. So you got the income minus the expenses gives the net income. So we're all used to that, right? The net income. That's what happens to that net income. Well, it flows and passes through to you, or you and your partners. So this isn't probably the best drawing, and I'm not trying to act like I know all about how this works, but it's basically you get taxed here on your W-2, 1099, K-1, then your companies pay tax, but that income, that net that's left, flows through, and you are left holding the bag. So, therefore, that is exactly how I owe that much in taxes, but I didn't even make that much. Fair enough? So let's talk about how this is actually working, because obviously this is 2024 taxes. It's not, and depending on when you're watching this, but those taxes are not due right now, so I still have some time. But there was a giant rush at the end of the year for me to get some specific things done. So let's start with those things that are really important that you get done in the current tax year. And I'm going to start with oil. Yeah, that sludge that's down in the ground that you always hear about, the stuff that you put in your cars. Matter of fact, the stuff that is in just about everything, including, I think, even that and these, and well, this definitely has oil in it. But what's in there is actually water, not oil. So let's talk a little bit about oil. Now, oil is incredibly speculative. So if you're going to get into oil, just realize, like, you have a high probability of losing all of your money or some of your money, because not all of these oil projects strike oil. Now, I am very fortunate to be surrounded by a whole bunch of families that are in the oil business, multi-generational oil people. And I know these people incredibly well. I've traveled with them. I've gone on vacations with them. But here's what I did. I had a guy that I knew really well. He had been telling me about this oil project that he was working on and personally investing a lot of money in for quite some time. I would say probably for 2 whole years. And I sort of just ignored it because up to that point, I was using this complex trust structure thing. So I didn't really think I had a tax issue. But when I found out that I did, I gave him a call. His name's Bruce. And I said, hey, Bruce, you know that oil thing? You know, I know you were super excited the last time I saw you because you struck oil. Now, that's a key thing. This oil project had hit oil. It was already income producing. I said, by chance, is there any room for investors to come into that? And he said, well, not really. I mean, it's already struck oil, so all the investment's already in. However, Chris, I think my partner, because he didn't want to give up any of his shares, I think my partner might be interested in one more investor like you because he's got some soft costs he has to take care of before the end of the year. So lo and behold, I gave him a call, and yeah, he was willing to sell me roughly 5%. And that 5% qualified for some intangible drilling costs, which are things that you can write off because you can take bonus depreciation against them and all sorts of other tax things. I'm not going to pretend to be the expert. Again, I'm just telling you what I did. So let me just kind of show you how this thing should pencil out. Now, these numbers are estimates, not exact, because we haven't yet paid the taxes, but I'm just going to give you what my CPA has given me now. Now, let me first tell you, I'm in a 37% tax bracket. My state income tax for New York State is 9.7. So all in, I'm 46+%. That's what my tax rate is, state and federal, just so you know. This oil investment is going to benefit me in what's called a tax deduction. Now, I want you to understand the difference between two things. It's very important, so please, this is critical. You must understand the difference between a tax credit and a tax deduction. I never knew the difference between these two. So when I put money into things, I was like, oh, why didn't I get 100% of value? Because it's a tax deduction, which falls under line with that tax rate. So tax deductions are things that lower your taxable income. Does that make sense? So many of you put money into a 401k, tax deductible. Okay, which means it reduces your taxable income, which means that tax rate for me, 46%, is really important when calculating how much am I going to save if I put money into this oil investment. So I put 300 grand into this oil investment, and that had to be done before the end of the year. Tax deduction. And that works out to be roughly about a 36% savings. Now, it's going to be more, but I can't take it all up front. I can only get about 80%, give or take, in the first year, okay, 2024. The rest will kind of trickle in over the next couple of years. So it's roughly about a 36% tax deduction for me. That's about 107, let's call it 108,000. I'm rounding up. These are just estimates, okay? So I put 300,000 in to get about 108,000 off of my taxes. Does that make sense? Because that's all based on my tax deduction, which is my tax rate, okay? Now let's talk about a tax credit. You may have heard of tax credits like child tax credits, and you know those are dollar for dollar credits against your taxes. So if you got a $1 tax credit, that's $1 off the taxes. These are the best. So when you're looking at different things you can do, tax credits normally are the best ones to get, but also sometimes the hardest to find. Now let's keep going. The other thing that I did, so first was that oil, remember, it was about a 36% reduction or deduction, okay? Next, I went to my foundation. So my wife and I set up a private foundation. Now, there's different ways to do this. I'm not saying a private foundation is right for you. There's also charitable remainder trusts and all sorts of things. Consult with your professionals on that. But I wanted a foundation because I plan to do a lot of giving. See, that's the ultimate in the world is giving. If you give, you don't focus on the get, but if you give, good things happen. So we give a lot of money to our foundation. And then from the foundation, my wife spends a lot of time figuring out who do we want to benefit, who do we want to help. We do a lot of stuff with our daughter's school. We just did a bunch of work to their buildings. We're also pledged a bunch of money to build a new amphitheater where I can then go teach kids and their parents how money really works. You see how that works? I help build the building through donations to the school, which is a private foundation as well. And then because of that, well, I can ask for things like, hey, if I help build this thing, do you think I can go in and teach money, how money really works, the things that kids aren't going to learn in school? Can I teach that to these kids? Maybe the seniors, maybe their parents. Yeah, I can. So I put $705,000 and change into our private foundation. Now that money, once it goes into the foundation, that's gone. Okay, I can no longer use that money for personal benefit, period. Because, and that's the same for most of these. If you put money into a charitable remainder trust or a foundation, the money's gone. But you know what? Here's the thing. People don't do this because they're like, oh, I don't want to do that. Did you realize that money wasn't yours in the first place? That money was the IRS's. Read the tax code. Understand the tax code. Your tax bill isn't your money. You work and you pay taxes, but the tax part never belonged to you. So therefore, that's another really important thing throughout the year. Don't spend the IRS's money. Save it in a separate account, which I'm going to get to that in a second. But this private foundation, throughout the year, I make contributions into the private foundation. For 2024, it worked out to be $705,000+. Now, that sounds great, right? If I had over $1 million in taxes due, you're thinking to yourself, well, that's 705 away from the million and something. Wrong. It's the deduction. So now, how much of that? Well, the estimate that I got from my CPA says about 54% of that. So of the 705 and change that I put into the foundation, I'm going to realize a benefit of right around $370,000+ off my tax bill. See how that works? I put 700 in to get 377,000 and change off my tax bill. You have to understand that that's just the way deductions work. These are not credits. Now, on top of that, what other things did I do? Well, this is the easy, low-hanging fruit. I have self-directed SEP IRAs. So me and my wife maxed our SEP IRAs out. So in doing that, the SEP IRAs, I realized about a 46% tax deduction. So I can take that off of my taxes. Notice how my tax rate is 46%. When I put the money into the SEP, 46%, because I can take it all in that current tax year. But the best part about the SEPs or any qualified retirement plan is depending on when you're filing, so remember, I can make contributions into the SEPs right up to April 15th. I think that's still the date. They always change it around, and during the pandemic messed it all up. But if you extend that. So you technically, and again, consult with your CPA, could have till October to make your contributions to your SEP IRA. So the nice thing about that is if you kind of need deductions before the end of the year, these ones can be pushed down. So I focused on my oil investment. I focused on my foundation because those needed to be done by 12/31/2024. The SEPs, I could kind of kick the can. You know, another thing that I also did is I have a property. So I did what's called a cost segregation study, which allows me to take deductions against things and, you know, equipment. I don't even fully understand it, but not equipment, but like all the materials in the house, different things are depreciated at different rates. So what the cost seg does is gives you that benefit now. So my cost seg gives me about $54,000 in change off of my tax bill. And then the last thing was the Augusta rule, which is only a couple grand. But nonetheless, if you were to add all this up, if I was over $1 million in taxes, okay, that was my estimate. And then I did the oil, I did my private foundation, I did the SEP IRAs, self-directed SEP IRAs. I did a cost segregation study, I did the Augusta rule. Now, the remaining amount of taxes are roughly about $563,000, which I did make more than that. But to get that down, I had to put over $1 million of money into those different things if you were doing the math. Now, not a lot of people can do this unless they had been saving through the year, which indeed I had been. Not enough. Let me be clear. Not enough. You see, this one kind of was like a Mike Tyson left hook. You ever watch Mike Tyson box? He's going, you think he's going to throw the right, and he steps with that left hook and out, you're down for the count. That was what this tax bill was, because I had it in my mind that it was going to be one number. And when my CPA brought me this ginormous 7-figure number, I'm like,
Mark, I think you screwed something up.
He's like, no, Chris, you did really well. Your companies did phenomenal. Look at this. You did this, and you did this, and you did this many millions. And I'm like,
yeah, Mark, that's great. I didn't make that. That was all operational income, and like then we had expenses.
He's like, yeah, well, you didn't spend enough money. I'm like,
Mark, I can't spend it all. I need operational capital for the next year and the year after.
And he says, well, you did really well. You had really good profits. And guess what? Now, because you had really good profits in your companies, that flows through to you. Congratulations. I'm just kidding. But that's basically what it was. So now let's move over to, now what am I going to do? I got this $563,000 and change remaining amount after I already put over $1 million away into these things. These are big numbers, folks. And I know some of you are going to have some negative comments about this, but that's fine. This should just be a guiding path, a wisdom dump on you to get you to start learning how this works so that when you're in the situation like I am and Mike Tyson throws that left hook and knocks your ass out, you'll know some of the things you should do. You might not be there now, but you will be. And if you don't think you will be, you got to change your mindset. Nothing else matters. Change your mindset to say, I will have $1 million tax bill. I will make millions of dollars a year. I will figure out how to pay those taxes. See, that's my story. Everything I'm talking about are mistakes I've made that led to this point that has forced me to learn how this all works. The very last thing I want to talk about is tax credits. Now, this is brand new to me. I am by no means an expert, but it's freaking fascinating. How many of you watch movies? Like you go to the theater and you watch a movie, maybe you sit down, you watch Netflix. Maybe you're doing that Netflix and chill thing if that's still a thing the kids do, but you watch a movie, right? Let's say you're watching a movie with Mark Wahlberg and you're like, I love him, he's such a good actor, blah, 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 or Denzel Washington, or any of them, Richard Gere, and you're watching the movie. Do you know how that movie got funded? Where did all that money come from? Oh, was it the producer that just put up all the money? No. They got investors into the movie. But why would people invest in a movie when a movie is such a risky thing? You think oil is risky? Investing in a movie is even riskier, even if you got Mark Wahlberg or Leonardo DiCaprio. I mean, movies fail all the time. So why would people put money into a movie as an investment when they could do all sorts of other investments? Oh, that's funny. You should ask that question. Let me come right over here. It's called Section 181. You see, this is a tax credit. So if you invest in a movie, as long as the movie qualifies for these tax credits, you see the government came up, or the IRS came up with all these different credits so that people would invest in US-made movies. So all that money that is spent to make a movie, which can be millions, hundreds of millions of dollars, is done on US soil to benefit the US economy. Because the government doesn't want you making your movie in Ireland. They don't want you making your movie in Russia. They want you making your movie here, and they incentivize you to do that. It's right in the tax code. Look up Section 181 and the bonus and the credits that you can get, the bonus depreciation and the credits you can get. It's really good. Let me just tell you how good. I just looked at a movie. As a matter of fact, it's a movie that is being produced by Lionsgate. I was asked to invest into it for 2025 tax credits. This is fantastic. I said, well, yeah, I'd like to know some more about this. Well, you can, for every dollar that I would invest into this movie, I would effectively get about $1.80 in total tax benefits from that. So I put $1 in and I get $1.80 that benefits me not paying more in taxes or me getting a tax deduction and a tax credit. Think about that. If I put $1 into an investment and I got $1.80 back, what would my return be? 80%. Although I'm not getting a return. I don't get that money back. Okay, I put the money in and I get a tax credit and a tax deduction that works out to that. But now let's move on to another thing that I've really been learning a lot about, and this is in the tax credit realm, but it is solar tax credits. There's a ton of initiatives and incentives out there for solar. You all know about this. Now that may change in the coming years, but right now it's good for the getting. So solar tax credits are my plan. Now solar tax credits, there's lots of different ways to do it, and I'm just going to tell you about the way I'm doing it, but you get between $1.40 to $1.80 per dollar invested in the solar. Now here's the one I'm doing, and you can do it levered or unlevered. Now let me just talk about the simplest way. This big solar deal was brought to me. It's about $1.2 million. It's a church. They're putting solar panels on the top of a church, which will save the church a ton of money. Now, churches, as you know, are multi-generational. They're around for a long period of time. So solar is a really big thing for churches and schools and campuses, any business that's going to be around for a long period of time. They realize a huge benefit over the long run. But these churches, they don't have that money to put a $1.2 million solar facility on their roof, do they? No. In comes me. This deal was brought to me, so if I were to write a check for $1.2 million, which I don't have $1.2 million right now to write the check, but that's the levered part. But if I were, I would basically fund that solar project. I would own that equipment on the top of those roofs of the church. So all that equipment is owned by me, Mr. Chris Naugle. And the church then pays me a loan repayment for that equipment because eventually the church wants to own it. And that term can be 7 years, 10 years, can be negotiated. So they pay me an income on that. But because of what I'm doing, all that equipment's going to depreciate. You think solar panels are worth the same amount next year and the year after? No, they depreciate just like your car. So therefore, I get to take what's called get this right, because there's different variations, a 168 bonus depreciation. Now, here's what sucks. In 2025, that bonus depreciation that I get is only 40%. But you see, the Trump administration has basically made it clear that they're going to redo or keep going the Tax Cuts and Jobs Act. And if they do, what that means is that bonus depreciation will bump back up to 100%. And they've even said they're going to go retro, which means instead of being 60% last year and whatever it was the year before, all those could potentially bump back to 100%, which would be phenomenal. Because all those solar panels, now you get to depreciate 100%, where right now I can only factor 40%. So to bring this thing to a close, everything that I talked about is my situation. Has nothing to do with yours, not giving you any advice, just trying to get you to start realizing there are things out there and there is different things you can look at and possibly do, as long as you consult with your CPA and a good tax attorney to make sure it's right for your needs and goals. They will help you tremendously. Because at the end of the day, none of that money is yours. It's the government's. All you need to do is decide, do you want to give that to the government or do you want to find a way to keep more of that money in your control? Speaking of control, another thing to really help every one of you make more money, build more wealth, and control more money is what we always talk about, which is be your own bank. So if you follow my other videos, which I'll put one up in just a second, you will learn how you can be your own bank and how you can control your money. But you'll also learn how there is a way to grow your money in a tax-free environment that will definitely benefit you in the future, because tax-free is tax-free. Another thing you need to be doing is throughout the entire year is you need to set up a separate account, bank account, wherever, or maybe use one of those specially designed and engineered whole lives for this, but set up a separate account where you put your tax dollars, the dollars that are going to go to one of these things or just be paid to the government. Keep that money separate. It's not your money. And if you go and spend it, the tax man's going to come hunting you down at the end of the year because you spent their money. So I think the most important thing is seek good counsel. Seek good advice. There's plenty of bad advice out there. Find your way to the good advice. My wisdom hopefully is going to come through in this video and you're going to be piqued. It's going to pique your interest to go try some new things. But with this all being said, the infinite banking concepts will help you pay less in taxes in the future, because you can grow your money, compound your money, but not have to pay tax every year. It's great you got a bank account that's making good interest right now, but at the end of the year, what do you get? A 1099. You got to pay tax on that interest that you earned. Well, change where your money goes first, and you will start figuring out the tax advantages in the life insurance business, specifically designed and engineered whole life. But nonetheless, if you like this video, you're going to want to check this one out, The Secrets of the Wealthy. With that being said, folks, thanks for letting me share my journey, my tax journey, and the wisdom and the failures that I've had through this. I hope to see you on the next episode of What Now? What's next? What's next for your taxes? See you next time.